Welcome to Financial Management and Modeling for Entrepreneurs. And I just want to start by telling you the difference between management and modeling. And modeling, financial modeling, is the key to management. Financial modeling shows you what the impact is of changes you make to your business, and that allows you to better financially manage what's going on, allow you to see and set goals and achieve goals, and to make sure that you always have enough cash on hand to run the business. So I'm going to cover 6 core areas in this program here. We're going to start with an overview, which basically answers the questions of what are financial models and why do we need them. I'm going to then go through assumptions and how important assumptions are, walk through the 3 financial statements, talk through the relationships between the financial statements, discuss financial ratios, what they are and why they're important. And finally, I'm going to give you a walkthrough example. You have a worksheet on financial modeling that you can fill out for your business. You also should have an Excel file that you can create your financials with. And I'm going to actually walk through an example of a financial model in Excel so you can see exactly how to tailor your Excel financial model and how to build a financial model. So let's start with what is a financial model. A financial model basically is your business in numbers, and you can see on the left side of the screen here, we have sample revenue projections, the years and how much revenue you're generating. And then on the right here, we see your 3 pro forma statements, your income statement, your balance sheet, and your cash flow statements. And this is everything here. It's all based on assumptions. For example, who you hire and what assets you buy and how they depreciate, and your loan repayments and dividends. And so, bottom line is that a financial model takes all the pertinent aspects of your business and it projects what would happen to your bottom line if something changed. So you change an assumption, you hire one less person or one more person, or what happens if you invest $50,000 of marketing dollars in this or that. It allows you to figure out the impact of each of those events on your bottom line and your financial needs. So I want to walk through why build a financial model, and there are several reasons. And the first reason is a financial model allows you to think through your business the right way. Creating a financial model, it allows you to essentially walk through your business model and to think through all of the items. For example, to think through your revenue streams and projections, direct costs of your product or service, your operating expenses, what capital expenditures or fixed assets you'll need to incur. And also, what personnel will you need to hire and how many of them. So, really developing the financial model, it forces you as the entrepreneur to answer these questions. And you might notice issues when answering these questions that you might not have thought of before. For example, you might start thinking about your costs and you say, if we may have to pay commissions to our salespeople, and you have to build that into your financial model. If you don't, what happens is that companies who don't do this correctly, they run out of capital and they fail. Also, going through this process, you start realizing, hey, I need money for this, capital expenditure or that expenditure, and it's really important to have that done. From an investor standpoint, it shows the investor that you've taken the time to think through everything about your financial model and that you have sound judgment in your thinking and your reasoning, and it's a solid financial model, which means it's a solid business. Second reason why we build financial models is, as I started alluding to, which is investors. Investors and lenders need to see a financial model in order to make good decisions on whether to lend or invest in your company. Essentially, their financial models, they're educated guesses and assumptions about your business. It can allow the investor or lender to see how you're thinking about the business and does it make sense? Is your reasoning clear and grounded? What's the value of your business? How much is it worth based on the projections? Where sources and uses of funds is, where does the money need to come from investors or from operating revenue, or you're generating enough revenue to fund a piece of your business, and what are the key uses of those funds? Why do you need capital? the investment amount combined with the revenue helps determine their ROI, their return on investment. And so that's why investors are going to look at your business model and your financial model to determine, hey, is this a good investment decision for them? Now, your financial model and your planning has to be, as I said, clear and grounded. For example, you can't project to generate $75 million in revenues if you only have a $50 million market size. And so that's why it's so important to make sure that your assumptions are grounded, that you've really thought through your model. And by going through this process and really understanding how the model works and how if you increase your marketing expenditures, your revenues will go up, etc., that allows you to create a solid model for your company. Now, investors will most likely, the more sophisticated they will likely edit your assumptions, and they'll say, hey, how about if the company only grows by 10% instead of 12%? And the financial model allows them to do that, allows you to do that, allows the investor to do that, so they can see what happens in different scenarios. Now, what specifically investors look for in a financial model? First thing they do is they're going to look at reasonable assumptions. For example, if you say you're going to penetrate 80% of the market in year one, that's going to seem incredulous. They're going to look at your direct and your indirect costs. They're going to look at your COGS, which is your cost of goods sold. They're going to look at your gross profit margins. Clearly, they're going to look at your bottom line, which is your net income and your net profit margin. They're also going to look at your EBITDA. That's going to be explained in more detail later, exactly what EBITDA stands for. And also for a lot of businesses, they're going to look at your break-even analysis, how long it takes to break even. So another reason why we build a financial model is changes. And the financial model allows you to see what happens to your business if you make changes. So, for example, what happens if your shipping costs increase? What happens if you use debt financing instead of equity? The difference there would be with debt financing, you have to pay monthly, quarterly, or annual interest and principal payments. That affects your financial model. What happens if you have new operating or capital expenditures? What happens if you sell less units? And the key point here is don't just enter your business blind. You got to create a financial model. And the picture on the left here is showing your average price. And what's cool about a financial model is you're saying your average price in year one is $15. Well, what happens if you go out there and try to sell for $15 and nobody wants it, but the market at $10 is pretty big? And what happens to your financial model? Can your business survive, or what do you have to do? And it's very important to see that beforehand and to start making decisions regarding your business. What would happen? What if? What then? And so you can make your decisions beforehand and set yourself up for success instead of a possible disaster. So next, I'm going to walk through the assumptions, which are the backbone of the financial model. The financial model, what's key is you'll see it's bunch of worksheets in Excel working together and linked together, but it's all based on the assumptions. So how many units you're going to sell, what the price is, what your salaries are, and we're going to walk through that. So the information in the assumptions tab of your financial model, it flows into the rest of the model. So we have all these different tabs of your model you'll see in your Excel worksheet, like your income statement, your balance sheet, and your statement of cash flows, which are the main three. And then you have different assumptions tabs like capital expenditures and headcount and depreciation. And when you change the assumptions tab, you see everything else change. And so it really just drives your financial model. So let's talk about the assumptions here and what the components of the assumption section include. So we have revenue drivers here, which are the assumptions that affect your revenue, such as how many sales and what your price is. We obviously have your direct cost structure, which are some of your key assumptions. We have your operating expense assumptions. We have your assets needed, what assets you need to buy for your company, equipment, vehicles, buildings, and what your timeline is. Clearly your personnel list and your hiring timeline, who you're going to hire, what positions, what salaries, and when. Another key assumption, set of assumptions are your tax and depreciation rates, and finally your loan schedules if you're doing debt financing. So I want to talk through the top-down approach to assumptions. Now, in estimating the amount of projected or future revenues, the top-down approach uses the following steps. The first step is you determine the market size and how big is this market that you're going after. And what I like to use is the relevant market size, which says that if 100% of relevant people bought our product or service, what would the market be? And say, hey, there's 100,000 potential buyers, and we're going to sell our product for $80. That would mean the market it's an $8 million market. And so you look at that relevant market size, and then step two is you assume a capture rate. We believe that we can capture 10% or 50% of the market, and that's how we determine sales. And then you combine that with pricing to estimate future revenue. So you can do it as what we think our revenues are going to change, how our pricing is going to change over time. Or once again, if you just ignore the pricing at first and you say, hey, our market is 100,000 people, and we believe we're going to capture 10% of that or 50%, and then you multiply that by your price assumptions, and you can figure out revenue. So examples would be, if you think that your market for your product is 100,000 potential buyers, you plan to capture 1% in year one. That means 1,000 people would buy your product. If your product sells for $50, then you could expect $50,000 in revenues in your first year. So that's the top-down approach. And so just walking through that again, step one was 100,000 businesses in your area. Step two is a 1% capture rate. That gives you 1,000 customers. We have our 1,000 customers. We call it 50%, $50 per license if it's software, or $50 per sale of a product or service. That gives you your $50,000 in revenues. Now, the bottom-up approach is the second way to look at your assumptions, and that's similar to the top-down approach, but it's in reverse. So the bottom-up approach is as follows. You begin by starting at the bottom of your business, which is, examples, price per unit or the number of units sold, the employees and their output. So you're basically estimating the total sales for each time period, either monthly, quarterly, or annually. You're saying, okay, we're going to sell this many units, rather than saying, here's the market, and working at the market level and say we're going to get a percentage of that. You're going to work from bottoms up and say, hey, we believe that 100 customers will come into our restaurant today or tomorrow or next month, or 100 people will buy our new product. And then with the bottoms approach, you then have to compare your projections to the market. And this goes back to, again, you can't say project $75 million in revenue in a $50 million market. So you got to make sure that it's logical. So I just want to walk through that. So let's say we have 10 salespeople, and we believe, looking at a bottom approach, that each salesperson will get 100 sales each, let's say per month. That's our past salespeople have done 75 sales a month. We think with advanced training and better salespeople, we can get to 100 sales a month. So that means we'll get sell 1,000 units a month. And step two is what is our revenue, which is the 1,000 units per month times our $50 license or fee per sale. That gets us our $50,000 in revenue. And so that's the question here is is this logical? And that's a check, which is we said before that. We had 1,000 units. We said before that we think there's a potential of 100,000 units in the area. That gives us our 1%, which we did in the other approach, the top-down approach. So the numbers, you should really get to the same thing, but a lot of times it's easier to do a bottom-up approach where you can say, how many people will actually buy this product or service, and you can build it that way. So I want to walk through, make sure you understand assumptions in detail. I'm going to spend some more time talking through each of the key assumptions. And the first one I want you to understand is direct costs. And this is known as COGS, or cost of goods sold. And this is best is illustrated by examples, which is really the cost of the product itself. So if you manufacture staples, a stapler, and you manufacture staplers and you sell them for $10, what does it cost for each stapler? What does it cost you to manufacture that? Or if you're, your sales organization, what commission do you have to pay your sales reps? Or if you're shipping something, what are your shipping costs? Or if you are at a store, at a restaurant, your cost or your cost of goods sold, or the cost of the materials that you use, your labor, cost of the ingredients, and credit card fees. And so, direct costs are costs. Direct costs are also known as variable costs, and they increase as sales increase. So, we're a restaurant. If we sell, $10,000 worth of bills today, if we get $10,000 worth of receipts or customers today, it obviously is going to cost us more than if we sold only $1,000, because at $10,000 we're going to incur more credit card fees, more food fees, etc. Just like the example once again, if I manufacture staplers, if I sell 1,000 staplers today, it's going to cost me more than if I sold 10 staplers, because I got to pay for all the manufacturing costs. The next set of assumptions has to do with operating expenses, and these are also known as fixed costs, and these are the constant costs, and these are the costs that don't change even if times are good or if times are bad for most of it. These are fixed, so these are things like rent and utility and management employee salaries and legal, accounting, and insurance costs. And let's go back to the restaurant example. Whether we have 100 customers on one day or 500 customers on that day, our operating expenses or fixed costs are the same. We still have to pay rent, we still have to pay utilities, we still have to pay salaries. Now, restaurants are a little different. That a lot of the employees may like particularly the wait staff are going to work a lot on tips, but you're still going to have to pay the dishwasher the same amount whether the restaurant was packed or whether it wasn't. You're still going to have to pay the same annual legal fees and insurance fees regardless. So these are your operating expenses or your fixed costs. The next set of assumptions are known as CapEx, and CapEx is just abbreviated for capital expenditures. And another word for capital expenditures are assets. And assets are different than supplies that you use right away. Assets are what you own that are going to provide value to your organization over time, and as a result, they're not expensed all at once. So, a supply, if you buy a ream of paper that you're going to use within the next month or 2 months, you, in your financial model and in your accounting statements, you expense them. You treat them as an expense, and they're deducted from your revenues to get to your P&L, your profit and loss, and your net income. Assets are depreciated over time because they last multiple years and they generate revenue over multiple years of your company. So machinery, vehicles, office furniture, computers, they're all, land is not depreciated, but because it doesn't decrease in value. But things like a computer, if you look at your business and say, hey, I want to buy a great computer, and most likely that computer is going to give you value this year and probably next year, and maybe to a third, fourth, or even fifth year. So it's really not fair to your business if you buy a computer if the expense of that computer is only included in year one, because it's going to make your year one profits look terrible because you're going to use it on multiple years. It needs to be spread out. The cost, and that's what depreciation does. It spreads out the expense of that asset over multiple years. The next key assumptions that you go through are your hiring schedule and your headcount. Now, hiring schedule for personnel, it's going to cover who you initially hire as well as all of your future hires. And you'll see that the salary expense, this is going to go right in your income statement. And here the image here is showing on the Excel portion of your financial model in terms of your assumptions tab. It shows here salaries, and it could show, okay, hey, we're going to hire these people. We're going to start with a president and chief marketing officer and a chief executive officer and a head of finance, and or maybe we won't hire these people till year two, and here's what their salaries are going to be, and here's what their salary growth rates are, and we're going to hire this number of sales reps and what they're going to be over time. So your hiring tab and your hiring assumptions walks through, very importantly, who you need to hire to grow your business. And once again, you need to say, you're going to see, hey, what happens? We're looking to hire a head of finance. What happens if we pay that person $90,000 versus $50,000? Can we afford to pay them $90,000? And what's cool about financial models, once again, is you're looking to hire somebody new. You can plug in the figures and the salary, and you can see how that affects your financial model. Can you afford that person? What that person's impact is going to be on the bottom line of your business. So another assumption here has to do with financing, which is your loan repayment schedule. Now, if you borrow money to finance your business, then you'll use a loan schedule to show the timeline of debt repayment. And as many of you are aware, when you take out a loan, there is principal and interest payments. You pay a little of both. And the principal payment, let's say you get a $1,000 loan, the principal is $1,000, and over the life of the loan, you may end up paying back, $1,500. You pay back the $1,000 principal, and then the $500 interest. So each period, you're paying back part of the principal to reduce the original amount of that loan, and that interest is that fee that's applied to the principal that's outstanding, and outstanding meaning still unpaid. And you can see the chart on the right here. For the example here, we have an interest rate of 1% paid over a 6 month or 6 period time interval. You can see here that each month, let's say we had a balance of $10,000. We say each month we're paying back $1,725, and $1,725 times 6, you're seeing that we're paying $350 worth of interest over this period. You can see here how your effective interest rate is going down because you have less principal outstanding over the period of the loan. So that's really the core assumptions. And now I'm going to walk through what the key financial statements are. And this is really the income statement, the balance sheet, and the statement of cash flows. And the income statement could be known, is known as the IS. The balance sheet sounds abbreviated as the BS or B/S, and then the statement of cash flows is the final statement. So let's talk about the income statement. Let's talk about what the income statement is. The income statement really captures the profit and loss of your company. It collects and captures the real operations of your business. It's a moving picture of your firm over a specified period of time, and there's what's known as an annual reset. So every month and every quarter and every year, your income statement starts at zero, versus a balance sheet where it starts at something because you have assets. Let's say you buy a computer, in time period zero, that's going to stay on your balance sheet possibly for 5 years because it's a long-term asset. Your income statement starts at zero. It resets every time period. It doesn't really capture what generates these numbers. And those are really, once again, the assets that your company has with tangible and intangible assets that allows you to generate the revenues. This just talks about what those revenues and what those expenses are. Now, the income statement, it lets you see sort of like a report card, how your business did over a certain time period. And that time period could be annually, it could be quarterly, and it doesn't go on forever. It's a specific time period, and this is very important versus the balance sheet, because the balance sheet once again goes on forever. And you buy an asset now, and it could be on your balance sheet for 30 years or more. The income statement represents several accounting principles that do not necessarily reveal much about the business on the surface of things, but net income, for example, does not mean that your business is doing good or bad, but it just shows, what your bottom line is and how, the financial health of your company here. And so if you look at the image on the right, what the income statement looks like, it shows what your revenues are. So, and then it takes away, talks about your direct costs, what are your costs of generating those revenues, and you basically take revenues minus direct costs, you get your gross profit. Then you subtract your other expenses, which leads you to your EBITDA, and then you get rid of depreciation and interest. You get your taxable income, and then you get your what you pay in taxes, and then you get your net income. And we're going to walk through in the following in the following minutes, we're going to walk through in detail each of these sections of your income statement. So let's talk about the revenue section. It's the first line on any income statement. It's how much business or how much revenue you generated during that specific time period. For most businesses, we refer to that revenue as sales. And in the example here, a company X made $1,500 in revenues in year one. They had two revenue streams, this and that. First revenue stream generated $1,000 of revenue, the second $500, and that's the revenue portion. 1,000 plus 500 gives us $1,500 worth of total revenue for the period. Now, your company may have just one revenue stream, or it may have 10 or more revenue streams. Every company is different, and that's fine. So the next section is your direct costs. As we discussed previously, the direct costs are like cost of goods sold. They are specifically traced or tied to the amount of units sold. And the example of the stapler, which is, okay, we sold 1,000 staplers at, let's say we sold them at $10 each, so we generate $10,000 worth of revenue, but it cost us $3 per stapler, which means our direct costs are $3,000, or $3 times 1,000 staplers. So once again, this is our COGS, or cost of goods sold. There are more, costs than just the material costs in terms of there could be labor, there could be materials, there could be credit card fees, there could be hosting costs. If you're a website, it would be direct costs. There could be shipping costs as well. And, basically direct costs typically come directly after your revenues, and then you subtract them from your revenue. So once again, these are expenses that are directly tied to the products that are sold. It doesn't include include labor that is directly tied to the product, but it doesn't include marketing costs or the cost of the salary cost of the marketing manager. And we'll get to that in our operating expenses later. So working on the right in the income statement here in the image, we take our revenue, we subtract our direct costs, and we get to our gross profit and our gross margin. And so in this example here, we generated $1,500 in revenue. We had our direct costs were $500, $300 of labor and $200 of materials, which gives us $500 direct costs, and we subtract the $500 from the $1,500 revenue, and we get a $1,000 gross profit. Now, gross margin is an important calculation, which just tells us it divides that $1,000 by the $1,500. So it divides gross profit into the total revenues, and in this case shows us we have a 67% gross margin, and lots of different businesses have vastly different gross margins. For example, if you are a product distributor, so you you buy products that you then distribute to supermarkets, you may have very, very low gross margins. So you may buy cereal from the large cereal company for $2 a box, and then you sell it for $2.25 to the supermarket, who then resells it for $2.75. So you have a very small gross margin, but you have a lot of products. So you may sell $10,000 boxes worth of cereal every day. Yeah, you're only making a dime or a quarter per box, and your gross margins are very low, but you have a lot of throughput. And so gross margins an important figure, particularly if you're paying for labor and materials, because you're going to be constantly thinking about, okay, how about if I bought this new equipment that would replace some of my labor or reduce my costs, and my gross margins go from 50 to 80%, what does that do to my bottom line? And that's why gross margins is a very important calculation. Moving on to other expenses on the income statement, we have this broad category of business-related expenses that we term your operating expenses. And these expenses include things like rent, your marketing expenses, utilities, and a category called SG&A, which is abbreviated for selling, general, and administrative expenses. And the key here is that if your business stopped producing units to sell, you would still incur these costs. These are your fixed costs once again. So we're manufacturing staplers, and if tomorrow we shut down the plant and we say, hey, we're not going to we've sold enough staplers and there's no market right now. All of our customers have just bought year supply of staplers. We don't need to manufacture any more staplers for the next year. You can, reduce. You're not going to be manufacturing staplers anymore. Your cost of staplers, you're not going to have any. You're not going to bear that $3 in material fees or labor fees for staplers, but you still are going to have to pay rent. You're still going to have to pay your marketing expenses if you're still selling them, and your utilities and your other fixed costs. Now, moving down our income statement, the next key factor we come across is our EBITDA. So we just figured out our total other expenses, and then below that we have our EBITDA, and that stands for earnings before interest, taxes, depreciation, and amortization. And EBITDA in this case is $700. We took our $1,000, which was our gross profit. You may recall that we had $1,500 in revenue minus $500 with direct costs. We had $500 gross profit. $1,000 gross profit. We take away our $300 in fixed costs or other expenses, and it gives us $700 in EBITDA. Now, EBITDA, why EBITDA is so important is that it's a key term when selling a company. And let me explain why. If somebody was to buy your company, if a larger company was to buy your company, they may, interest, they may not have to finance their business, and they may not have any interest expenses. Their tax structure would be different. They may not depreciate the assets the same. They may not amortize the assets the same. And so essentially, they're going to look at your business based on EBITDA, because the expenses that transform EBITDA down to net income, they may not incur them, or they may incur them differently. And so most businesses are valued on a multiple of EBITDA. So in this business or that business, they may say that most companies are valued or sold at 6 times EBITDA, and that's why EBITDA is such an important figure to understand for your business. I'm going to walk through the expenses below EBITDA, and the first two are depreciation and amortization. And what these mean, it's the declining value of both tangible and intangible assets, respectively. So, and depreciation has to do with tangible assets such as machines or buildings. And so machines, for example, may be depreciated over a 5-year period. Like a computer, you say, hey, I buy a computer for $1,000. I'm going to depreciate that $200 per year for 5 years. At the end of 5 years, my computer is now worthless. A building a non-residential building may be depreciated for up to 39 years. So you buy a building, it has a much longer life, and clearly it's worth something up to 39 years, but you could probably have to put more work into it and more upkeep into the building. For amortization, these are intangible assets, such as the value of a brand. In terms of looking at this, these are non-cash expenses. You're not writing somebody a check for depreciation or for amortization. Your depreciation and amortization are non-cash expenses, and they are reflected in the income amount. In the taxes that you pay. And so the good news here is that your computer that you purchased, a $1,000 computer, you're not taking that $1,000 out of off your revenue and calculating taxes. You're going to take that $200 or the 1/5, because if it's appreciated over 5 years, out of your income. But the good news is that in later years, you also get to expense those assets as you depreciate them over time. Just a much more accurate way, because if you're using a computer over a 5-year period, it's just not fair to assume all the costs in year one. It'll make your year one income look terrible, and that's just not right or fair, because you're distributing that asset over a multi-year period. Now, let's give an example of a delivery vehicle on depreciation and amortization here. So if you look at if you buy a delivery vehicle, you don't expense it on your income statement. Buying a vehicle for your business, let's say you're a dry cleaner and you want to start, a delivery service, or if you are a restaurant, you want to start a delivery service, buying that vehicle is considered an investment in your company. It's an asset. You expense things that aren't recurring, that don't generate the income. They're just costs. So assets generate income. A delivery vehicle generates your income, from delivering pizzas or whatever you deliver. Once again, like a machine generates income because it allows you to constantly make more products. And so just so you really understand assets versus expenses, the delivery truck, if you're a pizza shop, that's an asset. It's going to give you value over time, and it allows you to generate revenue. The ingredients that go into the pizza, those are an expense. The metal parts that go into a car, those are expenses. They're reflected in the income statement, but the assets, they're reflected in the balance sheet. It's only the part of the assets that are depreciated that you see on the income statement here. So in terms of the delivery vehicle, you can see here in year 0, right when you buy it, it's worth $25,000, and depreciated over 5 years. After year 1, it's worth only $20,000, and you're gonna include $5,000 that accumulated depreciation as an expense in year 1, and so on until year 5, where your delivery vehicle has no value on your balance sheet. It's you've depreciated fully, and you're not depreciating it on your expense in your income statement anymore because you've already expensed all of it. I want to talk next about EBIT, which is your operating income, and you can see EBIT's just EBITDA. We got rid of the D and we got rid of the A. So it's EBIT is EBITDA minus depreciation minus amortization. In this case on the chart here, you don't see amortization because amortization is only when you have intangible assets. So we took our EBITDA, which was $700. We subtracted the $200, which is getting us to our EBIT figure of $500. And so this is a figure, if anyone asks what your EBIT is, it's $500 once again. That is your EBITDA minus depreciation and amortization. So I want to talk about taxes now and your interest in taxable income. Your interest is your interest payments made on loan or other debt. It does not include principal payment. Principal payments is strictly on your balance sheet. And your interest that you pay is a cash expense, and it lowers your taxable income. Now, your taxable income, usually your income is taxed at a 35% tax rate, and that's what's going to determine your tax expense. It obviously depends on what state your business is in and how you're incorporated, but the average is at 35% tax rate here. And so you can see here in the example that we had our taxable income of $300. If we're in the 35% income tax bracket, and let's say all that income flowed through, we'd pay a tax expense of $105, which would lead to our net income of $195. So looking at our net income, the entire statement, looking at our bottom line, the net income line, the final line item on your income statement, it's also known as your profit. It's also known as your bottom line, because it is the bottom line. It flows into your retained earnings on the balance sheet. We're going to get to the balance sheet in a minute, and we'll see how that net income figure goes right into your balance sheet. And the significance here, net income is a very significant number on your business. It's a very important account line that it does a good job in displaying how your business operated. So you can look here, was the business profitable, and how profitable or how unprofitable was the business. However, net income can easily be misleading as well. If, for example, you have a huge amount of depreciation, which once again are non-cash expenses in 1 year, then your net income could very well be negative, even if you're essentially turning a profit. And so you got to keep that in mind. And this is another example of why EBITDA is commonly preferred as a business benchmark, because it becomes before things like depreciation and amortization. That's why this information is really important. So once again, our profit in this scenario here is $195, and a final ratio that people like to see is, what is your profit margin? And this is net income divided by revenue. So, it's great when you tell somebody, hey, we generate, $2 million in revenue this year. Well, what's your profit margin on that? What at the end of the day, out of that $2 million, if you generate $2 million in revenue, but you had $3 million in expenses, that's not so good. And that's why your profit margin is a very important indicator of your financial health. But once again, your EBITDA figure and your EBITDA margin may be even more important. Now that we've walked through the income statement, I want to walk through your balance sheet and what that's all about and why that's so important to your business. So we're looking here at a balance sheet, and the balance sheet displays what generates your revenues. It does not display the results from what was generated. That's in the income statement. It's really indirectly shows how your company generated revenue. It shows what your assets are that allowed you to generate the revenue. You can see the assets on one side and your liabilities and equity on the other side. So it displays your assets and the ownership of those assets, and the balance sheet is assets, your liabilities, and your equity, and it gives a good snapshot of the company at a specific moment in time. So usually we do the balance sheet. We usually look at it at the end of each quarter or at the end of each year, and it carries over from year to year, month to month, quarter to quarter. And the key here, once again, is that your income statement, once again, resets to zero every time period. Your balance sheet continues on. If you have $17,000 worth of cash on December 31st, most likely on January 1st, the next period, you start with $17,000 worth of cash. The money didn't just disappear, and so your balance sheet carries over. So I want to talk about things you must know about your balance sheet, and the key here is you have assets on one side and liabilities and equity on the other side, and the key check on your balance sheet is that assets always equal your liabilities and equity. And when you do accounting, that's why there's always a double entry system. And we'll talk through that in a moment so you can understand that you're always doing one thing. For example, if you buy an asset, I buy a car and I spend $20,000 on the car, I get an asset worth $20,000. Well, something has to, if I'm adding $20,000 worth of assets, I either have to be increasing my liabilities and equity by $20,000, or I have to be reducing some other asset like cash by $20,000. There's always a double entry to make sure that assets always equal liabilities and equity. So your assets are broken down into your short-term assets and your long-term assets. And really the definition of an asset is something that gives you a probable future economic gain, either in the short term or in the long term. Our short term or current assets, for example, are cash, accounts receivable, and inventory. And everyone knows what cash is, but let me walk through accounts receivable. Accounts receivable is what your customers owe you if you sell on account. I like how, for example, let's say you sell an order to Walmart. They give you an invoice that says, hey, we're going to pay you $100,000 for that, but they have not paid you yet. So it's nice to have that invoice from Walmart saying they owe you $100,000, but cash is obviously better. So the customer gives you, an invoice, a signed invoice, that's good, but it's an account receivable. You have that piece of paper in your hand, and the cash will eventually come to you, but it may take a week, a month, 6 months, or whatever amount of time. That's what's known as accounts receivable. And this is a good time to point out another flaw with revenues on the income statement. If your business runs purely on accounts receivable, let's say you sell to big organizations like Walmart or Target, and it may take you 6 months or more to collect those checks, things become very complex because the day you sell to Walmart or Target, you're going to say, hey, we generated that revenue. You're going to put that on your income statement, but the cash doesn't really come in, and so your balance sheet may look very different than your income statement. So you could be highly profitable and say, hey, our income statement says we made $1 million, but you could run out of money and go bankrupt because, yeah, you made $1 million, but you haven't received that money. It's in the hands of your customers, and you could run out of capital and go bankrupt because you have no cash flow from it. And that's why the balance sheet and your cash flow statement are so important here. The definition, going back here to your current assets, are they're short term. They're used within 1 year. So once again, we see on this balance sheet here, $100 worth of cash, $100 in accounts receivable, and $200 worth of inventory. We have total current assets of $400. Moving on to our long-term assets, they're often referred to as fixed assets. Although from an accounting standpoint, that is not sufficient. You got to say other assets and intangible assets is how they're broken out. So we're dealing here mostly with property, plant, equipment, your intangibles, which are your patents and intellectual property as well. And you're also going to show here your accumulated depreciation, which increases as your plant, property, and equipment depreciates. And so that has to do with your depreciation schedule, and that as you depreciate your equipment, and that goes into your expenses, and it goes to your expense on your expense part of your income statement. That's going to add to your accumulated depreciation on your balance sheet. Talk about liabilities. Liabilities, like assets, are broken up into short-term and long-term, and it's what you owe. A better, yet more complex way to think about liabilities is that liabilities reflect the portion of assets that debtors own of your business. It's probable future economic loss, things that you owe. So it's what the company owns, or you can think of it as debtors' claims to your assets. So the liabilities portion of your balance sheet, current liabilities, these are things that you owe that need to be paid in less than a year, such as notes, which are debt that you owe. Current liabilities could be inventory that you need to that have already been purchased from you that you need to deliver within the next year, could be considered a liability. Your long-term liabilities could be your longer-term loans or other debts, a 7-year SBA loan maybe. These are things that are carried for more than a year. We talked briefly about interest payments versus the principal payments here, and it's important to note what belongs where. Let me just walk through this once again. The notes payable, the current liabilities, just going back to there, is that this is the opposite of accounts receivable that we talked about a moment ago. These are things that you have to pay, but you haven't fulfilled yet. So you get the bill for your rent or for your phone bill. You owe this, but you have not paid it. It's a liability that you owe the phone company this amount of money or that amount of money, versus once again your long-term liabilities, which are generally longer-term debts that you have more time to pay. And once again, with interest and principal here, the principal portion is going to be long-term, and your interest payments are going to fall into the notes payable or short-term. So once again, you take that $500,000 loan, that $500,000 principal of loan is going to be a long-term liability, and in the short term, it's going to be what of that amount, what interest is due that year, and then once again your loan value will go out, your principal amount will go down over time as you pay partial principal. I'm going to talk next about your stockholders' equity portion of your balance sheet here. Excuse me. And this has to do stockholders' equity, or simply equity, is the owner's claim to assets. And this section grows as you retain more net income from your business operations. It can also grow from paid-in capital. And this is when paid-in capital is basically the cash your business raises from investors. Now, if you bring on an investor to pay in additional capital, you do dilute your ownership, and that is your claim to assets just decreased because you just gave away some ownership of your company here. And so, look on the right here, you can see the equity portion is, the share capital, how much equity and how much, possibly outsiders have come in there and purchased shares of your company. And then you have your retained earnings. So retained earnings, that comes from your income statement. That is the accumulated net income that you've generated from your business. And then the share capital is the investment from the owners of your business, both internal owners and outside owners of your business. Now, the balance sheet is a balancing act. And I mentioned the double entry system earlier, and we'll go through that more now. The key here is that assets must always equal your liabilities and your equity, and there's obviously a lot of accounting rules that you're subject to, which are known as the generally accepted accounting principles, or GAAP, that govern your balance sheet. Now, when you do it for yourself, you can be a little less interested in all the specific GAAP rules in terms of depreciation and how long certain assets are depreciated for your business, and you can allow your accountant, when he or she prepares your taxes, that those GAAP rules are critical. For financial modeling purposes, those figures are less important. You just follow the model. So the key here is that every action has a reaction on either that side of the balance sheet or the other side of the balance sheet. And I'll give you some examples. An example I'll use here is the purchase of a delivery vehicle as the example here. And so we buy a delivery vehicle for X $1,000. And what that means is that we're gaining an asset. We now own a delivery vehicle that is our vehicle. But at the same time, we're losing an asset. So that vehicle cost us, $10,000. We now own a $10,000 vehicle, but we just lost $10,000 in cash that we use to pay that vehicle. So our equation remains the same. We added $10,000, a $10,000 asset, the vehicle, and we lost $10,000 asset, cash. Now let's look at raising equity. So an investor comes in and writes us a check for $100,000. On the left side of the equation, our equity portion and the paid-in equity section increases by $100,000, and our assets increase by $100,000. We now have $100,000 cash in the business. Looking at that as right on the statement here, let's look at the delivery vehicle example here. We, in this case here, let's say we started with $1,100 in cash. We spent $1,000 on the vehicle. Our cash went from $1,100 down to $1,000, but our property, plant, equipment, we just added the $1,000 vehicle, and so we now have that as an asset. And we see how that decreased our cash, but increased our long-term assets. Looking at the example of the investor, our cash would have increased by 100. Let's say the cash increased by 100. They put in $100,000, increased by 100, and our share capital may have been $350,000. Now went up to $450,000. So it affected your left side, your cash side, your asset side, and also your right side of your balance sheet. So I want to walk through now the final financial statement, which is your cash flow statement, which talks about really where the money is going of your business. And it's probably perhaps the hardest statement to understand, but it's absolutely critical. And it talks through the sources and uses of cash and force you to ask yourself what you did with your cash and where it came from. Sometimes items such as decrease in long-term debt can be confusing, but when you think about them correctly, it makes it a little easier. And I'll walk through that briefly now. So there are three categories, as you can see. There's operating cash flow, there's investing cash flow, and there's financing cash flow. And what this does is a lot of this information is going to flow from the other statements, particularly your income statement, and some of the information is going to flow from your cash flow statement. So let me just give you an example here. Your operating cash flow, plus your net income, which means that, if you start with let's say the starting balance of $50, if we generated our net income of $195, that's going to be added. We look at how our cash flows, we're going to add in that income. We're going to say, hey, we start with $50, we generate $195 in net income or profits. At the end of the period, we're going to have at least that much money, the 50 plus 195. And then we're going to add back things like depreciation, because remember that was a non-cash expense. And then, look at the investment here. Let's say, fixed asset sales. Let's say that we were able to, sell assets worth $500,000, but we also, acquired, paid for $600,000 with new products, new assets. We lost $100,000 in that section, or we raised $100,000 worth of equity that came in as cash, and that's going to affect our statement of cash flows as well. So really, it's looking at how much money you started with. Did you generate or lose money in your operations? Did you generate or lose money in or spend more than you earned in assets? Did you buy more assets than you sold? And from a financing perspective, did you bring in more new financing than you paid off? Those three things affect whether you're going to have more or less cash at the end of a period here. So let's look at the operating cash flows. We're looking here at operating cash flows basically correct the mistakes that the income statement makes, and that is that net income, as we discussed, is not the best reflection of your business performance. I mean, think about it this way: did you pay any cash for depreciation? No, this is a non-cash expense, and thus it's added back to your net income because you actually still have this cash in your account. Changes in working capital deal directly with the management of your business operation, and this goes back to the comments I made earlier about accounts receivable. If you increase your accounts receivable, that means you have less cash now. And let me explain that to you exactly what that means. So let's say that at the end of last period, you had $100,000 in receivable, and now you have $200,000 in receivable. That means you're owed another $100,000. That means your cash essentially went down by $100,000 because once again, you're booking everything as revenue, and that's on your income statement as a profit. Conversely, if your liabilities went up by $100,000, that means you have more cash. So let's say that you have, you haven't paid your bills yet. That means because you haven't paid your bills, that money's still in your bank account. And so that's why the cash flow statement is so important. So what you're doing here is you're starting with your existing cash balance, you're adding your net income, you're adding your depreciation because that was a non-cash expense, you're increasing your accounts payable, things that you have not paid, and you're subtracting both your increase in inventory and your increase in accounts receivable to get your net operating cash flow. Next section is your investing cash flow. It has to do with your capital expenditures, your non-operating income, and this is your long-term assets. And so, an example, if you're in the pizza delivery business and you sell that delivery vehicle, then you're selling a fixed asset. This is not reported as revenue. That's not revenue when you sell an asset from an accounting standpoint. So, yeah, you're generating, you sell that vehicle for $500. You're generating $500 worth of cash, and that's going to go into your investment activity. It does not belong on your profit and loss statement. And from a tax perspective, usually when you sell an asset, you get long-term gains tax. You'll pay less. You'll pay like a 20% gains tax, which is positive for your business. In terms of the the statement of cash flows, when you go through the full statement, I want to talk a little bit more about this. If you raise equity like venture capital, it will be placed in the cash flow the financing cash flow section of the cash flow statement, and after adding your net financing cash flow to your net investment cash flow to your net operating cash flow, that will get you to your ending cash balance here. And you can see here in this example here, we start with $50 or 50,000 or whatever units we're using here, and our net change is a positive 50. So at the end of the period, we raised, we have 100. Our cash balance is 100. Now in this sheet, it states that you raised $100,000 from equity or 100 from equity. However, you also paid off, your debt by 100, and you did this and that, and so overall, you can see here that during this period, you brought in $50 more than you started with, and that's why you're cash flow positive for this period, and your ending balance of cash is higher than your beginning balance. So once again, walking through the calculation, we're starting with our initial balance. We're adding our cash flow from operations. We're adding our cash flow from investing. We're adding our cash flow from financing, and this gives us our net change in cash. Once again, we're adding that to our beginning balance. It gets us to our ending cash balance, and this is going to flow to our balance sheet. This shows exactly how much cash we have at the end of the period, which goes directly onto our balance sheet. So I want to talk about the overview of relationships and how the financial documents work together. So some relationships between these financial documents are highlighted, but there are several. So let's start with this. In order to double check your cash balance, which is what the statement of cash flows essentially drives from your financial model, you got to start with your net income here. And you can see here that your net income, your $195, flowed directly to the net income portion of your cash flow statement. The cash balance that we generated, we talked about $100 at the end, that flowed to our balance sheet. We see that at the end of on the right, the cash balance that we ended up with on our statement of cash flows goes right into your balance sheet here. And so to review, you start with your net income on the income statement. The net income flows and is the first line of your cash flow statement, and then you proceed with your cash flow statement until you get to your ending cash balance, in this case $100, and that cash amount reflects the amount found on your balance sheet. And that's how these three statements interact, and a lot of the calculations on the statements, like your increase in accounts receivable and inventory, those are automatically done in the financial model by going to your accounts receivable from your last periods on your balance sheet to see what the change is and how that affected your cash flow. So I want to talk now about your key ratios and your break even that you should be keeping an eye on to successfully financially manage your venture. The first one here I'm going to talk about is return on assets. And the calculation here is your net income divided by total assets. And return on assets is a common measure of how well your company earns money. Now, think of it as your company's efficiency, or how many dollars you make for every worth of assets. And obviously, you want this number to be as high as possible. So let's say you were lucky enough to purchase a $100 million business. You would hope that you can generate a lot of income based on the fact that you just bought a $100 million asset, and you would think you'd be able to generate more income than if you purchased a $1 million asset. And so that's what return on assets is, the income you generate as a percentage of the total assets that you acquired or have. Your current ratio is a quick way to estimate your company's liquidity. Liquidity has to do with how much cash flow you have on hand. Every industry has a different benchmark for what this ratio should look like. If it's too low, the company might be experiencing financial distress and have difficulty meeting its short-term obligations. Now, a ratio that's too high might indicate that the firm isn't using its assets the right way. So the calculation here is your current assets divided by your current liabilities. Current assets, once again, defined as cash, inventory, and accounts receivable. Your that's your current assets. Those assets, once again, that could be used within 1 year. Current liabilities are liabilities due within 1 year. Your accounts payable, your notes payable, your salaries payable. Once again, if this figure is too low, there are definitely cause for concerns that you don't have enough assets, current assets, to cover your liabilities, and your business is at risk of running out of capital and going bankrupt. So you got to be careful. That's why you want to look at your quick ratio, your current ratio. Your next ratio I want to talk about is your return on equity, and this is your net income divided by your equity invested. And this is a very common ratio used to evaluate investments. And think of it this way: how many dollars of profit were generated for each dollar of equity? Obviously, the higher this number, the better. So if equity is invested, you want to generate as large a profit as possible from that equity. Inventory turnover. This is your cost of goods sold divided by your inventory. This is a measure of how quickly you sell inventory. You think of it this way: how many times did you sell your entire inventory in a year? You're sitting on, is it once a year? You're sitting on inventory for 365 days, or are you selling it 6 times a year, or 12 times a year every month? Because it is expensive and unnecessary to hold inventory for too long, it's good for this number to be fairly high. Now, your break-even analysis is just very, very important. Your break-even analysis in units tells you how many units you need to sell in order to start making a profit. Taking your investment and your fixed costs into account, and your contribution margin is, which you can look at here, is how much each unit contributes to covering the fixed costs. Once you cover your fixed costs, you have broken even. And so if you look here, if you have fixed costs of $12,000, so you're paying $12,000 for rent and salaries, and you're paying that regardless, and you sell a product at $8 and your variable cost is $5, that means you're making $3 per unit. That means that you need to sell 4,000 units. That's at $3 gross profit per unit times 4,000 units. That gets us to our $12,000 fixed cost. That's our break even. And so your contribution is $3 per unit sold, contributes to your to paying back your fixed costs, and it's a 4,000 units is what you need to sell, and that's what you need to get to break even. That's really important for assessing new products or services. How many do you have to sell to get to break even? And for new companies as a whole, which is really showing, okay, here's our company, here are our fixed costs and our variable costs, and this is, we think it's going to take us 6 months to break even. And particularly if you're asking for outside capital, you want investors or lenders to see exactly how long it takes to break even, because you can't fully pay anyone back or make a lot of money until you break even. So everyone wants to know how long till break even, how long till break even. Now, your sales break-even analysis simply tells you how much you need to sell to break even. The principle is the same as unit break even, but it may give managers a more realistic figure to work with. In this case here, you need to sell $32,000 worth of product to break even here. So you can say, hey, we need to sell $32,000 worth of product to break even here, and this allows you, in this case here, you're looking at, it allows you to tell your salespeople, okay, what the revenue goal is rather than a unit goal here. You can see the calculations on this page that allow you to look at it that way. It's just another way of looking at break even. And now what I'm going to do is I'm going to walk through the actual Excel financial model that you have. Okay, I'm going to walk through the financial model and how you complete that. So when you open the financial model, the first tab is directions. It's very, very simple. We basically have it set up that just follow directions. Two things. You change the assumptions on the Quick Assumptions tab by typing numbers into the yellow highlighted cells. And just by doing that, which I'm going to walk you through, your complete financial model will be done. Then if you'd like, optional, to create even more customized or detailed changes to the assumptions, you can modify the full assumptions and or the headcount tab. So let me walk you through. I'm going to click on the bottom here, Quick Assumptions, and I'm going to walk you through the Quick Assumptions. All you're doing is you're reading the sort of question and the notes, and you're typing your answer into the yellow highlighted cell. Now, for this example, I'm going to choose to use a retail tire company. So a company that sells tires, because I think everyone could relate to that and understand that business. It's fairly straightforward, and clearly you can apply this to any business. So you just need to read the question and answer it. So the first question essentially is, what is the number of units, or tires in this case, that you expect to sell each month? Now, sometimes we fluctuate between month, quarterly, and annual. So that's why I want you to read this and make sure that you know what it's saying, whether it's month, quarterly, or annual. And the reason we do this is that sometimes it's easier for you to answer the question monthly. You can get a sense of how many am I going to sell per month. And a lot of times for investors or banks that you're presenting the financials to, a lot of times they just want to see quarterly information. It's a very important note, because when you look at the full financials that you're going to complete here, the way it's set up is that it's going to complete your financials quarterly for the first 3 years and then annually for years 4 and 5. Now, you could say, hey, I want to complete them monthly for 5 years or weekly or daily for 5 years. The point is you don't need to get that much specificity, nor can you possibly do it. There's no possible way that you can accurately predict what's going to happen in month 10, let alone month 26, or let alone month 53. It's just so far in the future that it's really hard. And that's why we want to project and get a sense of what's going to happen, but you're never going to get it exactly right. So you're estimating here to get a sense of what this business looks like, to confirm that it's feasible. Very importantly, to figure out how much money, if any, you need to start the business and make sure that you never run out of money. So it really helps you think through the business and present it to understand how much money you might need and how much money you can expect back. So let's start with the first question once again. What's the number of units you expect to sell each month? For all of these cells, once again, the cell being this 3,000 here, I've already included numbers in here so you can just see how, give you an example of putting in a number here and see how the when you can click through each tab now and see how it looks. But you're going to customize each one. So I may say that I believe that in the first month, I'm going to sell 500 tires, okay? And I believe my annual growth rate, the percentage increase of tire sales each year, I think I'm going to increase by 15%. So all I'm doing here, I just typed in 500 into this cell, and this cell, I'm going to type in 15. I think it's 15% growth rate. The average price that I charge, maybe I think I'm going to charge $125 on average per tire. Maybe that means that some tires will sell for 100 each. Some tires will sell for 150 each. But let's say my average is $125. I'm just typing this in. And let's say I believe my price is going to increase by 5% per year. Next question is, what is direct cost per unit sold? Maybe I know, or I've talked to the manufacturers or distributors, and they say that the cost per tire is generally half of what I charge. So the average tire of $125 retail price, I'm going to buy from my manufacturer or distributor for $62.50. And I think the quarterly growth rate in my unit cost may only be 2%, or maybe just say 1%. Type that in here. Salary, let's say I want to make $84,000 a year, so I'll type in $7,000 because this is per month. Okay, this is a reminder in this cell that you can further customize your salaries on the headcount tab. My annual growth rate in salary, I can leave. Maybe I want to increase by 5% per year. Other salaries, this is my staff. Now, once again, we're going to give you the opportunity to further customize this in the full assumptions and in the headcount tabs. But for now, you may have a relatively simple business that says, hey, well, listen, I have 3 people working for me. I'm going to pay them each $3,000 a month. So in total, my other salaries are going to be $9,000 a month. And they'll increase, let's say, by 3% per year. Marketing expense, I'm going to enter my initial monthly marketing expense. And let's say I believe that I'm going to pay $2,000 per month on local newspaper advertising, or $24,000 a year. So I'll type in $2,000 a month. And let's say I think I'm going to start to really ramp this up in year 2. So maybe I think I'm going to increase my marketing expense starting year 2 by 10% per year, okay, and spend $2,200 per month. Rent utilities, maybe due to the rent I'm going to pay for my retail location is maybe going to be $4,500 per month. And a typical increase, annual increase in rent would be 3%. Once again, you can change that if you'd like. Other expenses, maybe my insurance is about $6,000 a year, or $500 per month. And I think that my insurance is going to increase, let's call it, by 2% per year. Office supplies, maybe I think I'm going to pay $200 per month. Once again, I'm just typing in 200 here. I can leave this 3% increase in office supplies, or I can change it. Now we go into other expenses, and you may not have any other expenses, or you may say, well, yeah, I want memberships. I'm going to pay for memberships because I'm going to want to join my local Chamber of Commerce. I'm going to want to be a member of the National Tire Retail Association, and that's going to cost me, let's say, $200 per month on average. Maybe it's an annual dues of $2,400 per year, but on a monthly expense can be $200, and maybe that'll increase by just 2% per year. And maybe another expense would be events. I want to go to events each year, and that may be events put on by tire manufacturers to learn my trade and stuff like that. Maybe I think I'm going to spend on average $100 per month on events, and the growth rate is going to be maybe each year it goes up by 3%. And maybe there are no other expenses. Okay. Next section here is capital expenditures. And we refer to capital expenditures, also abbreviated as CapEx. And these are all the things that you purchase that are assets. These are your big purchases, and it says it here in the notes, dollar amount of key purchases you have to make to buy computers, desks, equipment, space build out, etc. So maybe I think I'm going to spend, I'm going to have to build out my retail location. Let's assume that's going to cost me $100,000. Let's say I need to spend $100,000 on equipment, those machines that pick the cars up, and those machines that take the, what are those called? The bolts off the tires to pull the tires off, maybe $100,000 in equipment. and then maybe I'm going to spend like, let's call it $35,000 in office equipment, desks, computers, and stuff like that. So $100,000 building out the space, $100,000 on equipment, on sort of equipment, tire equipment, and $35,000 on office equipment. That's $235,000. So I type that in here. And then the final question on the quick assumptions is what percentage, if I'm going to go for financing, is going to be financed by debt versus equity. Debt just being I'm going to have to pay that back like a bank financing. Equity is I don't have to pay it back. So this is just, these cells are just a formula. So here you enter the number in this cell here, B60, and this next cell here is just a formula. So let's say I say it's going to be only 75% debt, then it's automatically, as you saw, calculates to 25% equity. But in this case, let's leave it as 100% debt, because the likely example for a retail location is that's debt financing. So that concludes the quick assumptions tab. So you can see that was very, very simple to do. And before I get into the full assumptions tab, where you can customize this even further, and the headcount tab, I want to show you how by just changing these numbers, you've just built your entire financial model. So let me click through. I'm going to skip full assumptions for now, the summary. According to the numbers you just typed in, your assumptions, in year one, your revenue is going to be $808,000. It's going to grow to $1.77 million in year 5. We automatically calculate your expenses, your gross profit, your EBITDA, your income tax expense, and your net income. Everything is automatically calculated. Now, why is your revenue increasing each year? Why is your expense increasing each year? Well, these are just your growth rates. If we go back to quick assumptions, we see that, remember, we start with 500 sales a month, but we said that we're going to grow by 15% per year. We also said that our average price is going to grow by 5% per year, and that's why we're seeing in our summary, our revenue is growing by a compounded rate each year. I'm going to skip headcount for now. Income statement. Our income statement, once again, is calculated quarterly for year 1, 2, and 3, and then it's calculated annually for all years, including years 4 and 5. And our income statement just gives us a little more detail than our summary tab. Revenues, growth, and net is just giving you charts to show you your revenue, your gross profit, and your net income. Year 1 expense is just a chart showing your year 1 expenses. Balance sheet, like the income statement, it's broken out quarterly for fiscal years 1, 2, and 3, and then annually, also including year 4 and 5. Looking at column D here, if you already have a business, if you're already in business, you already have a balance sheet, let's say you already have assets, cash, etc., you put in your existing balance sheet here, and it will modify the full balance sheet going forward. So this column here, column D, is your initial balance sheet if you're not starting from scratch. Your cash flow statement here, this is your quarterly, once again, for fiscal year 1, 2, and 3, annually for all 5 years. You can see here, you may remember that $235,000 number that we put in the quick assumptions here. Go down here, that $235,000. These were your capital expenditures, and we see them. They just flow right into your cash flow statement because this is an investment that you made into your business. So all of these tabs, all these spreadsheets are interrelated. So when you change something in the quick assumptions, it flows all the way through to all of these other spreadsheets. Here we have your capital expenditures. Once again, that $235,000. We show your depreciation, how it's depreciating over time. And this is a full depreciation schedule to show how your asset, because basically depreciation is the value of your asset is decreasing over time. So when you have $100,000 in equipment, every year that $100,000 is worth less because you've sort of used some of those assets, just like a new car is worth X dollars, and once it becomes a used car, over time it loses value, and that's depreciation. And the good news for depreciation is that depreciation, even though it's not a real expense, you're not paying money out, it does decrease your taxes, and that's why we calculate depreciation. And finally here, the final tab is your debt repayment schedule, and this is showing the loan that you're taking out. Remember we said 100% debt in this case, and your interest and your principal payments. So once again, by just quickly completing those quick assumptions, which for many businesses, you may be able to do this in 10, 15 minutes, you've completed your full financial model. Now, let me go through the full assumptions in case you want to customize even further. As you can see by the directions, you're not required to complete this. This is if you want to further customize. We encourage you, if you want to further customize, you change numbers that are highlighted in yellow. You can also change the italicized numbers if you want to get even further customization here. Okay, so let me first show you that these numbers in the full assumptions are already linked from the quick assumptions. So going back to the quick assumptions, the first assumption was 500 units per month, okay? In the full assumptions, we do it by quarter, Q1, Q2, Q3, Q4, and then we do the years. So if we said 500 sales per month, quarter is 3 months, 500 times 3, that's where we get our 1,500. You can see the cell here, equals quick assumptions B6, which was the number 500, times 3. That's how we get 1,500. What this is showing us is that we're getting our 1,500 sales. Our growth rate, we assume 15% annual growth rate, and so we sort of break that out into 3.8% per quarter, and you could change that. You could say, we think that we're going to grow, by more than, we think we're going to grow by 10% after the first quarter, once people know about us, and then we're going to grow by 10% in the second quarter, but then starting Q4, we're only going to grow by 5%, so you just type in 5%. The other numbers automatically equal the previous number, so you can either leave that 5% or you can keep changing the percentages over time, your growth rate. Likewise, we talked about how we think that your average sales price can be $125, increasing each year. But you may say, well, listen, in the first month, we're going to offer everything at a huge discount to get a lot of new customers. So we think our average in the first month is only going to be $100. And then we're going to increase our prices by, 40%, or let's say 30% to get to $130. And then we're going to increase it after that by only 3%. So you're just typing in the numbers and further customizing your financial model. Once again, you don't have to do this, but if you'd like to get more nitty-gritty and really detail, you can do that. You can see here it's automatically calculating, your quarterly revenue, your annual revenue here automatically calculates here. The next assumptions here are our cost. Once again, we said it was going to be $62.50. We could change it. We'd say, no, we think it's only going to start at $60, but it's going to grow up by 5%. Or once again, we could say but it's going to be 5% for the first quarter, first 2 quarters. But after year one, starting in this is now Q1 of year 2, now fiscal year 2, we think it's only going to be 2% growth in cost. So you can further customize here. Now, just want you to know, when you further customize here, it does not overwrite back on the quick assumptions. The quick assumptions stay the same. You're just overwriting in the full assumption. So just so you understand how the spreadsheet works, the quick assumptions flow into the full assumptions, and the full assumptions then power every other tab. So if you modify the full assumptions, you are modifying the entire spreadsheet. Marketing expense, once again, we said $2,000 per month, which equals $6,000 per quarter. Once again, you may say, well, in the first quarter, we're only going to spend $2,500, but after that, we're going to really ramp up, and instead of 2.5% quarterly growth, we're going to do 50% quarterly growth, but then we're going to ramp that back down to only 3%. So once again, just changing the percentages, either the initial number and or the percentages to modify. Same with rent, same with other expenses. Tax rate, this refers to the common C corporation tax rate, state and federal of 35%. Let's say you're a special circumstance, it may be less. If it's 10%, type in 10%. If you're a nonprofit, type in 0%. Here's where you modify that. Salary expenses. Before we modify in the quick assumptions that you want to make $84,000 a year, we put you $7,000. That flowed through from quick assumptions. You now may say I want a customer service manager. customer service manager. And that manager is going to make $4,500 a month. Type it in here. Now let's say I have my tire repair crew. So I have my tire repair crew, and this is a staff role here. That relates to staff role down here. And this is when you have more than one person doing the same role. Say I have my tire repair crew, and let's say each tire, and I'm just copying this down here too. Let's say the tire repair crew, let's say each of them makes $2,500 per month. And let's say I'm going to start with 2 people on my crew. So I'm going to have 2 people, Q1, Q2, and then I'm going to start growing. I need 3 people. And then maybe I start needing, in the second year, I think I need 4 people. And then I'm going to need 5 people on my crew. And then I think I may add a 6th person and maybe even a 7th person as I grow my business. So here's where you're documenting your growth in your staff here. Your increased salary at 10% from the quick assumptions, your manager's 3%, your staff 3%. You can change here. Maybe you think your staff's going to grow by 3.5%. Or 4%. You can do that there. Okay, so those are your salaries. Next is your current asset and liability turnover. Now, if you just took our program on financial modeling and management, you remember that this refers to when you pay your bills and when you get paid. So let's say you get a bill from your tire supplier today, and a bill for $25,000 worth of tires you purchased. You're not going to pay that bill today. Generally, you're going to pay net 30, and that's why the default here is 30. Maybe in your business you don't have to pay for 90 days, so you change this to 90. Whatever it is in your business, but I'll go back to 30 for a tire retail business. Now, with a tire retail business, when you get paid is different than if you're in another business. So let's say the other business is I'm a manufacturer and I'm selling to Walmart. I may not get paid for 90 or 120 days, so I type that in here. But in a tire retail business, people are paying me probably, unless it's a corporate account, they're probably paying me with cash, which I get on day 0 immediately. Credit card, which generally I'm going to get paid within 3 days from my credit card company. Or check, which also is going to be probably within 7 days. So on average, I may get paid within 5 days. So I'm going to change this number to 5. And that's going to affect my cash flow because I'm getting paid faster. And that's going to flow through my spreadsheets. Your fixed assets here, this is a calculation. You can see the cell is not italicized or highlighted. You can always click on it and see the where the calculation is. So here, depreciation rate is over what period of time your asset is depreciating. And a lot of times your assets depreciate over 5 years, and that's why it's 20% per year. If your assets depreciate at 10 years, you can depreciate 10% per year, but you can leave 5%, leave the 20%. If you have a question, you can ask an accountant or look it up online what your specific asset might depreciate at. But 20% is very, very common. Okay, so now we're back to our CapEx or capital expenditures. Remember we talked about the $235,000 in capital expenditures. We talked about $100,000 in our retail space build out, $100,000 in equipment, and $35,000 on office equipment, desk, computer, etc. Now, that just took care of, in the quick assumptions, our initial capital expenditures. Now, we may say, hey, listen, we believe in Q2 of year 2, we're going to launch a second location. So we need another $235,000, but maybe we think prices will increase by then and we need $250,000. We just type it in here. And maybe in year 5, we think we're going to launch another location. It may cost us $300,000 to mean a more upscale location. And I was having trouble here. 300, 1, 2, 3. And you just type that in here. It's going to flow through your financial spreadsheet as well. So you can type in additional capital expenditures you're going to have over time, and you can see they automatically updated here in our total capital expenditures over time. Now we're into intangible assets, and most likely you're going to leave this blank, but this is if you have intangible assets like a patent, or if you're going to purchase intangible assets from somebody else, you just type in the amount of those purchases here. Next here we have our this is a formula here, but our total initial capital required. This is very important here. This, if you click on the space here, you can see here, this is a formula here. And when you click on the cell of a formula, Excel automatically highlights each of the cells that are included. So you look at this cell here, and in this case it says total initial capital required is $468,000, which seems like a lot. It is a lot. It seems like it's a lot more than that $235,000 we initially need for, we talked about the capital expenditure of $235,000. Why is it so much more? Because what we're doing here to make sure we don't run out of money, we're adding other expenses. We're adding intangible assets, which case is zero. We're adding here the fixed asset, the $235,000. We're adding other expenses for the first and second quarters, rent, utility for the first and second quarters, marketing expenses for the first and second quarters, and our total direct costs for the first and second quarters. We're really padding. We want to make sure we have a lot of cash on hand to handle at least 6 months of expenses just in case anything goes wrong. Now, you can modify that. If you don't want to, if you think, hey, that's too conservative, and I don't want to include all of that, you can lower that number here. Right here, you can lower that number and say, hey, we don't need $468,000, we need $400,000. But that's how this number is calculated. Once again, we already selected that it's going to be 100% debt financed. And now, because it's debt financed, we need to look at what our debt terms are. And this is talking to a bank and saying, what are they going to offer you? They may say, well, listen, we can offer you a 7-year loan instead of 5, so let's make it 7, and we can give you an interest rate of only 5%. You just type in the new numbers here. Once again, you type it in here, it's automatically going to change the other tabs of your spreadsheet to reflect that. That's what's so cool about this. Now, as I mentioned earlier, if you have an initial balance sheet, if you've been in business, you already have a balance sheet, just type in your initial balance sheet here, and we'll automatically update the other tabs, and also any preliminary expenses, if you want to choose to write them off over 3 years and be more aggressive depreciation, you can do that here by leaving this number 3, or you can change that back to 5 or a different depreciation schedule if you think that these are assets. And the main asset is land is generally depreciated over 20 or 30 years. So the key thing is that if you're buying land, you depreciate over a longer period of time. So that's the full assumptions. Once again, you change numbers in the full assumptions, automatically affects the summary, automatically affects the income statement, all of our charts, balance sheet, cash flow statement, etc. The final thing that you might want to choose to customize, once again, you don't have to, is salaries. We already further customized headcount and salaries in the full assumptions tab. Remember, in the full assumptions tab, we added the tire repair crew, the customer service manager. That is flowing through here. You're making $7,000. The customer service manager, $4,500. Remember here that we have the staff of 3 people. I believe we said 2 people on the tire repair crew. So 2 people times $2,500 each is $5,000 times 3 months in a quarter. That's why we get $15,000. You may remember in Q3, we added a person. Full assumptions, Q3, we went from 2 people on the crew to 3 people. That's why our expense went up from $15,000 to $22,500, etc. And that's what we're calculating here. We're calculating the salaries and the staff here. You might want to say here, you might want to add somebody else and add in a monthly salary here and further customize. Let's say you say for yourself that you want to have a massive increase. Starting year 3, I need to be making $10,000 a month. So you just overwrite it to $30,000 per quarter, and it automatically updates. That's why if you want to further customize, you can do so here. Just so you understand, we have here on top this. We calculate on the headcount spreadsheet 2 ways. We calculate the custom way that if you have customized the spreadsheet, or we show you what the numbers turn out to be if you just did the quick assumption calculations. And just so you know, in this case, when you customized it, the numbers went up. The spreadsheet automatically knows to take, if you've customized it, it automatically knows to carry on and flow through your customized numbers throughout the rest of the spreadsheet. So just don't worry about the quick assumptions. This just shows you how you calculated when you did the quick assumptions. So once again, it really finalizes and completes this walkthrough. The direction's fairly straightforward. Just go through the quick assumptions, read the questions and the notes, type in your numbers, see the outcome, and if you want to further customize, just go to the full assumptions tab and walk through the numbers, change as you see fit. I like to save a copy of the original somewhere in case I overwrite something by mistake and I know how to go back to the original. But so you can see it's fairly straightforward. I wish you the best of luck in completing it, and I know you're going to be very, very successful. So that concludes this portion.